Welcome to the deep dive. If you're here, you're looking for that shortcut to being well-informed, and today we are absolutely diving into a classic conflict.
Oh, yeah.
A major corporate transformation that delivered, spectacular growth on the top line, but a devastating surprise on the bottom line.
We're talking about Helmerich Payne, or HP, and their fiscal Q4 2025 results.
That's right.
And these results, they cover the quarter ending September 30, 2025. And this wasn't just some routine report.
Not at all.
This was the moment meant to validate the boldest move in the company's history, that massive integration of KCA Deutag assets, to make them a global powerhouse.
They spent the whole year building themselves into the largest active land driller in the world, over 200 operating rigs. But then the numbers hit the tape, and the market reacted with, let's just say, a lot of caution. The celebration seemed a little premature.
So our mission today is pretty straightforward. We need to figure out what drove that divergence. Why did the market just ignore the revenue victory and punish that earnings missed so hard?
It seems like it all comes down to some very specific, very painful costs hitting them right now.
Exactly.
So let's start with that snapshot, because it's a perfect example of why investors sometimes panic. Strong revenue, but the profit just vanished.
The bottom line disappointment was severe. So on a GAAP basis, HP reported a net loss of 58 cents per share.
Wow.
Now, management on the call was quick to break that down. They said, about 57 cents of that was from after-tax, non-recurring items.
Okay, so things like impairments, write-offs.
Exactly. Restructuring charges, investment write-offs, all related to this big global transition. They were essentially just cleaning house.
So if we strip out all that noise, all those one-time charges, where did they actually land?
They still reported an adjusted EPS net loss of 1 cent per share.
A loss of a penny.
And that single penny might not sound like much, but when you look at what was expected, that's where the gravity of the miss really hits.
Right.
The consensus estimate was for a positive profit of 26 cents a share.
So they missed by 27 cents.
Which means they delivered a surprise miss of about 105%. That is the kind of shock that just, it destroys short-term confidence.
A triple-digit surprise is always going to draw blood. But what makes this so tricky is that the revenue picture was stellar.
Oh, absolutely. Far from it. Revenue was robust. It came in at about $1.01 billion.
That's the third straight quarter over $1 billion, right?
It is. And it represents this impressive year-over-year growth of about 46%.
And that's all coming from the KCA Deutag deal and the international push.
That's the direct result of it, yeah. The strategy is driving the top line, no question.
So massive strategic success on one hand. On the other, these temporary costs and accounting choices that just crush the bottom line. And before we move on, we should just mention, from a cash perspective, there's still a fortress.
That's a great point. Q4 free cash flow was strong, about $154 million, and adjusted EBITDA was $225 million.
So operationally, the machine is still churning out cash, even if the income statement looks like a mess.
And that operational strength is exactly what management leaned on in their narrative. They called 2025 a historic year.
I bet they did.
Establishing HP as the global land drilling leader. Their whole strategy is built on this tripod: technology, disciplined capital, and, that new global scale.
But to really get the market's anxiety, we have to break down the segments. This is where it gets jarring. Let's start with their core North America Solutions, or NAS.
Okay.
NAS delivered peer-leading performance. Direct margins were $242 million. They held up really well, even with a lower U.S. rig count, and they grew their Permian market share to about 37%.
And that's where their technology isn't just a buzzword, it's really driving that margin stability.
How so?
Well, their digital application usage is up 20% year over year. And think about how complex U.S. wells are now. Over 40% have laterals stretching more than 3 miles.
So you need cutting-edge tools.
You absolutely do. Rig floor automation, high-torque top drives. That's where they lead.
And it shows. About half of their active NAS fleet is now on performance-based contracts.
Meaning they only get paid more if the client saves time and money. It's a huge vote of confidence in their tech.
Right. And their Offshore Solutions also did well, a record direct margin of about $35 million. Very stable.
So you have two segments just firing on all cylinders, really carrying the whole company. Which brings us to the elephant in the room.
The source of all the pain. International Solutions.
Yep.
It posted an operating loss of $75 million in the quarter. A devastating number.
Management immediately insisted Q4 was the margin low point for the segment, but yeah, That number is just staggering.
It really is.
And you have to remember what they're trying to do here. International is dealing with these dual pressures. One, the huge integration costs from KCA Deutag, and two, the immediate expenses of reactivating rigs for big new contracts.
It's hard to do both at once without some volatility.
Extremely hard.
So management is selling this as near-term pain for long-term gain, but, I mean, integrations often cost more and take longer than planned. Are we just supposed to take their word for it that Q4 was the bottom?
That is the core of the market's concern. That's the execution risk.
Right.
However, they did provide very specific details on the biggest growth driver, Saudi Arabia.
Okay.
They confirmed they're reactivating 7 more rigs there in the first half of fiscal 26. This is huge. It brings their total rigs there to 24 by mid-2026, a massive long-term revenue stream.
But that growth comes at a cost, right? And this is a technical point, but I think it's the key to the whole story. What's driving this near-term pain with the Saudi rigs?
This is where accounting choices are driving investor perception.
Yeah.
Management was very clear that the cost to get those 7 rigs ready.
Things like training, moving equipment.
Training crews, mobilization, safety certs, all of it. They are being treated as non-capitalized expenses.
Okay, let's break that down simply. What does that mean?
If a cost is capitalized, it's treated like an asset. It gets expensed gradually over many years, which smooths out your earnings.
And non-capitalized?
It hits the income statement immediately, all at once, like turning on a fire hose of costs. So management is choosing to take all that pain right now in fiscal 26.
Which guarantees higher, cleaner margins later on.
Exactly. But that decision is what created the 1 cent adjusted loss and is delaying the big profit inflection the market wants to see.
So this massive strategic move is driving costs, but they're also trying to signal financial confidence through capital discipline. Let's look at their guidance.
Yeah, the guidance is all about cost control and paying down debt, designed to generate cash flow despite that international drag.
Okay, starting with capex. Their initial guidance for fiscal 26 is between $280 and $320 million.
That is a material reduction from the $426 million they just spent.
And what's critical is that this lower number already includes all the capital for those 7 Saudi rigs, plus maintenance.
It's a very aggressive display of discipline. And they're also attacking corporate costs. They're guiding G&A expenses to be at least $50 million lower.
And what about the debt?
This is maybe the biggest signal. They're accelerating their debt reduction. They're now targeting the full payoff of their $400 million term loan by Q3 of fiscal 26.
In less than a year. Why does that matter so much right now?
It is management's loudest way of signaling confidence in their future free cash flow.
Right.
If they weren't absolutely certain that international margins would snap back, they would not commit to paying off that much debt that quickly. It's a very tangible vote of conviction.
So if they're so confident, why did the Q1 guidance basically confirm that the pain isn't over yet?
Because that non-capitalized cost fire hose is still running full blast in Q1.
I see.
So while NAS margins are expected to stay strong, 225 to 250 million, international margins are guided way down, just 13 to 23 million.
And that's explicitly because of those reactivation costs being expensed.
Exactly. They are telling investors, very transparently, prepare for margin volatility through the first half of 2026.
Which brings us right back to the stock's reaction. Shares dropped over 15% from the pre-release high to the low on call day.
Investors did not reward the strategic momentum at all. They focused entirely on the accounting, and that surprise, EPS loss.
And it seems like the market is translating all of this into one phrase: execution risk.
That's it. Investors aren't really doubting the long-term value of the Saudi contracts. They're worried that integrating KCA Deutag will just delay the inflection in earnings and free cash flow. They see cost overruns, transition delays, so they're applying a discount.
That perfectly frames the trade-off. Management is asking investors to see fiscal 26 as a bridge year. Focus on cutting costs, paying down debt, and getting set up for huge growth in 27 and beyond.
And the market is just saying, prove it.
Right. Show me.
But if you connect this to the macro environment, the strategy makes total sense, even with this pain. The U.S. market is all about doing more with less rigs, which favors HP's tech. But the real growth is in international and offshore markets. So the pivot away from being just a U.S. land play is validated by global energy demand. But these transitions, they are rarely smooth.
Which brings us to the segment where we try to connect all these dots into a speculative idea. This is not financial advice, We take all this analytical tension and craft an outrageous but plausible trade.
And the opportunity here is based entirely on a temporary disconnect. The stock price has been hammered by short-term accounting pain.
The non-recurring charges and that heavy drag from the Saudi rigs.
Right. The trade assumes management executes perfectly on this very ambitious schedule. You are basically betting that the bridge holds.
So here's the trade. You buy the stock or maybe a long-dated call option targeting the $30 strike. That strike represents a key resistance point where confidence would signal a strategic success.
And the catalyst isn't a surprise earnings beat. It's a financial execution milestone.
Exactly. We are targeting the successful payoff of that $400 million term loan by Q3 of fiscal 26, combined with those 7 Saudi rigs becoming full high-margin contributors by late 26.
The payoff logic is pretty compelling if they deliver. If HP cuts capex to that guided range and they successfully cut the $50 million in G&A.
And international margins normalize, moving away from that huge quarterly loss.
Then the free cash flow generation going into fiscal 27 will see a massive step change, a huge increase.
And that FCF compounding potential should trigger a big re-rating of the stock. The market will shift from focusing on P&L volatility to long-term cash generation.
The risk, of course, is that the volatility lasts longer, that integration takes more time, or the international market has delays.
Sure.
But the opportunity is rooted in the belief that the current low price is discounting temporary pain for guaranteed long-term assets.
That really is the core dynamic here. HP is balancing this massive acquisition and global ambition against significant immediate costs.
They're sacrificing margins in Q1 and Q2 to secure much higher returns down the road.
So we know their technology lead in North America is driving efficiency and peer-leading results. And that leads us to our final provocative thought for you to consider.
Given HP's track record with transferring digital expertise in the U.S., which allows for those really long, complex wells, how quickly will that expertise transfer and gain traction with their new international customers, especially in the Middle East? Because if that technology accelerates international performance faster than anyone currently expects, those fiscal 27 margins could look radically different, and it would change the entire long-term valuation calculus.
A great question to ponder as we watch the progress on that $400 million loan paydown. As always, remember, we are simply diving deep into the source material provided, and this is not in any way, shape, or form financial advice.
Not at all.
Thank you for joining us on the deep dive, and we'll catch you on the next one.